Welcome to this ACA Masters Masterclass. In this class, we'll be looking at the topic of replacement analysis. We looked previously at NPV calculations for projects to determine whether those projects had a positive NPV and therefore would increase shareholder wealth and therefore should proceed. Alternatively, if they had a negative NPV, the decision on a financial basis would be made not to proceed with those projects. We see an example here of the type of calculations that we did. Remember, NPV calculations are all about cash flows. And in this example, it was slightly different in that we did calculate a net profit with a depreciation element, but then we added back that depreciation to get us back to a pure cash flow basis. So generally, the shape of a project will be that we see the initial cash outflows in year zero. We normally have the assumption that other cash flows are made at the end of each respective year to keep things simple. And normally the outflow in year zero will be some sort of capital investment. And then we see that the cash inflows over the remaining years will start to pay back that initial investment and hopefully provide us with a return. We've also looked at the fact that the net cash inflow in each year is then discounted to reflect the present value of those cash flows. A pound income today is worth more than a pound income, for example, in 6 years' time, due to the fact that the money that you have today could be invested and earn a return over that period. And also inflation can affect the value of future cash flows also. So to bring the net cash flows back to present value, we apply a discount rate. In this example, we had a discount rate of 12%, and there's a number of ways that you can calculate the discount rate. In this example, we went back to first principles and we calculated the discount rate for year one as 1 divided by 1 plus the discount rate. So 1 divided by 1 plus 12% to the power of 1 in this example. The formula E6 refers to the number of years, and then so on. So in year 2, it was to the power of 2, in year 3 to the power of 3, and so on. And you can see that each of the discount rates is a reducing value as the value of future cash flows is less than the preceding year. To calculate our present value from that, we then multiply the cash flow for that year by the discount rate to get us the present value. And then we sum those present values and subtract the initial cash outflow, normally the investment, to give us an NPV figure. So in this case, we had an NPV of 33,657. So at the discount rate of 12%, that showed us that this was a project that would increase shareholder wealth and therefore should be undertaken. Remember, and of course, there can be non-financial aspects that may affect that decision as well. But for now, we'll concentrate on the calculation aspects. But sometimes we have a situation where we don't have cash inflows from revenue, as we saw in this example, but we're looking at an assessment purely from a cost point of view. So we're looking to compare the relative costs of different options and advise which of those options gives us the lowest cost and therefore the best option for the business. And you can look at it also as maintaining shareholder wealth by choosing the option which reduces shareholder wealth by the least amount. If we look at the FM materials on this topic, we can see that what we're looking to do with replacement analysis is we're looking to compare the equivalent annual cost of various replacement cycles and choose the cheapest. And quite a straightforward calculation in that a 1-year replacement cycle, we take the present value of cash flows divided by an annuity factor for 1 year. We'll come on to what that means shortly. For a 2-year replacement cycle, we take the present value of cash flows divided by an annuity factor for 2 years, and so on for each of the respective potential replacement cycles. So the important thing to remember here is that when we were looking at NPV calculations and recommendations, we were looking at a particular project, a one-off decision on whether the project should proceed or not. When we're looking at replacement analysis, we're looking at a replacement cycle. We're looking at a repetition of the cost outflows over a number of years. And the key thing with replacement analysis is to advise which frequency of replacement is the most cost effective. As we can see here, we'll introduce the concept of equivalent annual cost which is a way of comparing different replacement cycles on an equivalent basis so we can make an informed decision. The best way to look into this in more detail is to work through an exam question. So let's look at this example question. Question 1, Tamalama Beauty Limited. As usual, we recommend reading the requirements first, and that enables you to read the information in the question more actively and in the context of what you're being asked to do. In this question, the amount of information that you'll see is relatively limited, and that's typical for replacement analysis questions, but other questions can be much more complex in the amount of data that you're presented with. So it's important that you are focused on which information is applicable for each of the requirements to enable you to maintain a structure to your answer. So if we look at the requirements, requirement 1, calculate the optimal replacement period for the laser devices. So I'm not quite sure yet what these laser devices are, but it's clearly an item that's going to need to be replaced periodically. That's for 6 marks. And requirement 2, advise the group finance director. So important to note that we're being asked to advise the limitations of the approach used. And that's a very common requirement with replacement analysis questions. And as you go through the questions, you will note a repetition, a pattern emerging, which should give you confidence in your ability to structure your answer in the appropriate way. So let's go back to the context of the question. Tamalama Beauty Limited, Tamalama, is a UK subsidiary of a multinational beauty services provider and specialises in providing state-of-the-art laser beauty treatments to clients. So important to note that they're providing state-of-the-art services, so changes in technology can be important here. The Group Finance Director has asked you to report on the following issue. Issue 1, how often the company's bank of laser devices should be replaced. You are asked to provide advice on this issue and report to the Group Finance Director. So key point here is how often the laser devices should be replaced. So now we get into the information within the question. Replacing the bank of laser devices, Tamalama would like to decide how often it should replace its bank of laser devices. A new laser device costs £25,000, so that's the investment, and the technology of the devices is developing fast, and that's important perhaps for our narrative later on. Always good with narrative answers to make sure your answer is in the context of the question. So look for clues given by the examiner in the question as to the specifics around the business in question's industry sector, their priorities, which will make some of the narrative elements more important than others. The key to getting top marks in the FM exam on narrative requirements is not to just repeat textbook information, but to give answers which are in the context of the question. Tamalama has put in place service contracts which cover the full servicing, maintenance and repair costs. So as we said, we're looking to minimize costs by choosing an optimal replacement cycle, and the costs that we have here are wrapped up within service contracts. As you would expect, the costs vary with the age of the machines. So older machines are going to cost more for their service contracts. The likelihood of breakdowns, replacement parts, etc. is higher as the machines get older. The following information is available. So we have a table here with the interval between replacement in years. So we've got 3 choices, 1, 2 and 3. We've got a trade-in value. So although we've got the initial investment of 25,000, we've got trade-in value, which will be a recovery of part of that investment depending on the age of the machine when it's traded in. And then the service cost, which increases as the years go on, as we've just discussed. A suitable cost of capital for evaluating the replacement policy is 12% per annum. So they've given us the cost of capital that we need to use there. So that's nice and straightforward. So let's start to build our answer. So by now you'll be very familiar with the MPV calculation structure. So heading Tamalama Beauty, and what we want to do with the replacement cycle is we effectively want to do a mini NPV calculation for each of the replacement cycles that we are looking into. So in this situation, we're going to need to do 3 mini NPV calculations. Of course, the amount of information in each of those will be limited in volume, unlike a full NPV question within the exam. So let's start with our 1-year replacement. And we're looking at year 0, 1, 2, and 3. And we're going to be putting our investment in year 0. So as we saw from the question, our investment is £25,000. Cash outflow, so let's keep the convention of outflows being negatives and inflows being positives. We have our trade-in value when we sell the machine, and the trade-in on a 1-year replacement cycle will be at the end of year 1. So the trade-in value for a 1-year replacement cycle is £20,000. Cash inflow, so it's a positive number. So then we need to put in our service contract costs. So service contract for a 1-year replacement cycle is just £750. We note here that the service cost is paid at the end of the year. That's normally the case in the exam questions, that cash flows occur at the end of the year. But good that they've just confirmed that for us. So we have £750, and then we can add up our net cash flow. As we've seen, relatively few numbers in the many NPV calculation. We'll copy that all the way across, and then we can use this template for the other replacement cycles also. So now that we have our cash flows, we can work out our discount factors and our present values. So first, if we look at our discount factor, we saw from the question a suitable cost of capital for evaluating the replacement policy is 12% per annum. So 12%. And I'm going to show the discount factors on a first principles basis here. From previous classes, we've seen that there are 3 ways really of calculating the discount factors. You can use the table that's given to you in the exam. The limitation there is that it's only relevant for certain cost of capitals. You can use the first principles, which we're going to do here, which is helpful in demonstrating and understanding how the discount factors work, but it will also be helpful as we move on to explaining and calculating our annuity factors. And finally, the quickest way of doing the NPV calculations is to use the equals NPV formula. It works both in Excel and in the exam software. And in that way, you will use the discount rate and the cash flows from year 1 to the end of the project to calculate an NPV directly in the cell. Of course, remembering to put your workings so that the examiner can give you full credit for your work. So going back to the question here, we're going to calculate the discount factors using equals 1 divided by 1 plus our discount rate. And in year 1, it's to the power of 1. We're going to refer it to the formula there again so that we can use it for the other replacement cycles. And that gives us a discount factor of 0.8929. So then to work out our present value, year 1 onwards, we simply take our cash flow for that year multiplied by the discount factor to give us the present value of that year's cash flows. And of course, in year 1, we only have 1 year to do. So we've got a present value of year 1 onwards of 17,188. And then of course, we need to add the year 0 cash flow, which in this case is at 25,000. Just going to sum the present value for the years 1 onwards, and then we can get our total present value. The sum of year 1 onwards and the year 0 investment. So that gives us a present value of a minus 7813. It's a net cost. So that's unlike the NPV calculations for projects that we looked at, where we were looking at obtaining a positive NPV to increase shareholder wealth and ultimately to proceed with the project. But we're in a different scenario here. We're looking at comparing different replacement cycles. So let's do the same for the other years. So we can copy the template down. Remember in the exam, you need to be careful that formulae have copied correctly, but you can get the structure just so that it saves you a bit of time in retyping information. For the 2-year replacement cycle, we need to update our data. So the investment in year 0 is still going to be £25,000, but we now have a trade-in year 2 instead of in year 1. So in year 2, the trade-in value has dropped significantly to 14,500. And then we need our service contract costs for year 2, which, as we saw earlier, have increased substantially to £2,000 for year 2. Clearly, in this situation, we've still got the service contract cost in year 1 of £750, but then the increase in year 2. So that completes our cash flows. So we need a discount factor for year 2 now. And because of the way we've done the formula there, we can copy that across. Just need to fix by putting the $sign in column A for the discount rate. Now I can copy it across to year 2. That gives us a discount factor in year 2 of 0.7972. So I can just copy the present value calculation across. And our calculations have updated there. So we've got the present value for year 1 onwards of 9295. Our year 0 investment of £25,000, which gives us a present value of 15,705, a negative 15,705. Now, clearly this is a lot bigger than the value that we had for the 1-year replacement cycle. But of course, we're not comparing like with like, because we've now got this equipment in place for 2 years instead of 1. So you would expect the cost to be significantly higher. And of course, the cost increase that we're seeing is a combination of the reduction in the trade-in value, because we're selling it a year later, and an increase in the service contract value because the machine is older and the service contract provider will look to cover their costs. So we need to put the 2-year costs into an equivalent annual cost so that we can compare it to year 1. And as we saw from the study materials, the way we do that is we take the present value of cash flows, which we've just calculated, and divide it by an annuity factor for 1 year. And in the 2-year replacement cycle, we take the present value of cash flows, dividing it by the annuity factor for 2 years. So what is an annuity factor? Well, an annuity factor is simply the combination of the discount factors over the respective number of years, taking into account the discount rate. So this is why we've done this in this way, to use first principles. If we look at the annuity factor for the 1-year replacement cycle, it's simply the summation of the year 1 discount factor through to the end of the replacement cycle, which in this case is only the 1 year. So the annuity factor in our first mini NPV calculation for 1-year replacement is 0.8929. So we'll enter that into the table. Annuity factor equals 0.8929. And then, as we saw from the study materials, we're simply going to divide the present value of the cash flows by the annuity factor. So a nice and straightforward calculation. Present value divided by annuity factor, 7813. Divided by 0.8929. And that gives us a present value divided by annuity factor of 8750. And of course, that's called the annual equivalent cost. Now we can do the same for the 2-year replacement cycle. Again, just to demonstrate from first principles, copy the annuity factor formula down. And this time we've got year 1 and 2 to include. So we've got an annuity factor of 1.6901. Inserting that into our table. And then taking our present value divided by annuity factor calculation. We can copy that from above. Ensure that the integrity of the formula is maintained. And that gives us an annual equivalent cost of 9292. So you can see that already the comparison is much more meaningful, 8750 versus 9292. And between these two replacement cycle options, the replacement cycle every year is actually cheaper than the annual equivalent cost of a 2-year replacement cycle. And it's because of the way that the trade-in values and service contracts change between the two options. Always good to do a sense check on your answers. Clearly, if one of these came out at 20,000 and the other one was 7,000, you should check your calculations and make sure that something hasn't gone wrong with maybe a miskey of a number or a formula being wrong, perhaps when you've copied it down. It's always good to have that sense check. It's something the examiners feedback on a lot when they see some strange answers. So just recapping on annuity factors, as we talked about with NPVs, there's different ways these can be calculated. This is a good way, I think, of doing it for tuition purposes, in that you can see where the numbers are coming from, and hopefully it gives you an understanding of the principles behind what an annuity factor is. The other way of obtaining the number is from using the data tables within the FM exam. A similar table shown here, although these do have limited use in that they're only for certain discount factors. They're not for every discount factor. So if you look here, we've only got a limited number of discount factors in the table, so the examiner would have to give you one of those. But things are moving forward really in terms of less reliance on the tables, both for NPV and for annuity factors, and more towards doing the calculations within the spreadsheet functions. So let's now continue with our replacement cycle calculation for year 3. So we can copy that down, and just being careful that our formulae maintain their integrity. And we need to update our data within the table. So the investment is still £25,000. Service contract in year 1 will still be 750, and in year 2, 2,000. But again, we need to move our trade-in value into year 3. And we can see that in year 3, our trade-in value is £12,000. So it's reduced further. And the service contract in year 3 is £3,000. Again, another increase in the service cost as we expect. So we've now got our net cash flows. We need to copy our discount factor calculation across the page. And that gives us a discount factor in year 3 of the 0.7118. And now we've got an annuity factor of 2.4018. And that's fed automatically into our table. But we need to also copy our present value formula across. This is where copying template structures is useful, but you must retain your awareness of formulae that need updating or copying across. And that's where the sense check can come in handy. Clearly, without that formula copied across, we had an annual equivalent cost of 11,351, which is a little bit out of step with what we've seen in the other calculations. When we copy it across, we see that we now get an annual equivalent cost of 8684. So again, doing our sense check, does that stack up with other calculations? Well, yes, it seems to, because it's actually the cheapest of the 3 options, but it's still within the ballpark of those other calculations. So it looks like we haven't made a silly error there that we need to go back and correct. So that's completed our calculations. As you can see, there's not a lot of data manipulation to be done here, but it's important to get your structure established so that you can present the information in an accurate and structured way. We go back to the question. We've calculated the optimal replacement period for the laser devices. So let's just summarize that in terms of our conclusion. So 3-year replacement cycle gives the lowest annual equivalent cost. So replacing the laser machines, always good to repeat the context of the question, even just with descriptive items, so it shows you're referring it back to the actual question in hand. Every 3 years is preferable. So that should be sufficient for our 6 marks for this question. In the exam, you'd probably go through those calculations a bit quicker, but for tuition purposes, I've explained, going back to first principles, how some of those work so that you get a thorough understanding of the technique. So the second requirement, requirement 2, advise the group finance director of the limitations of the approach used. Again, a very common question. It's for 2 marks, so we want 2 or 3 concise, relevant points to get those marks. So from the FF materials, we've seen here very briefly, limitations are inflation and technological change will impact future costs. We also saw from the question that we've been asked to ignore inflation and taxation. So although we, of course, need to follow the instruction given within the question, it doesn't mean we can't comment on those as being limitations. So it's a good way of, again, picking up information from the question and using it in your answer. The examiner is trying to lead you somewhat in the answer that they're looking for. So let's put that into our answer. So requirement 2, limitations of the approach. Don't worry too much about typos. You won't lose marks for those as long as it's clear what your meaning is. Ignores inflation and taxation, which could affect future cash flows. Always good to question some of the data that you're given. It's the best estimate that they have at the time, but of course any market research, future costs, future trading values, they can change, and they're only a best estimate at a point in time. So that can change going forward. So certainty of future estimates. For example, again, use the information in the question. We've seen from the question we have trading values which vary significantly, and the market could change in the future. And a change in those trading values, we saw from the calculations that the decision wasn't an absolute clear-cut one. All 3 of the annual equivalent costs were fairly close together. So a change in those variables could lead to a different outcome and a different decision. So for example, trading value in fast-moving sector. Good to refer back to that because we've already seen from the question, they gave us a clue there that the technology of the devices is developing fast. So that could lead to high obsolescence in the laser equipment and therefore the trade-in values that could be obtained in the future. And finally, just building on that point, because there's a reason why the examiner has said the technology is developing fast, it may be that the move in technology means that continuing to use old machines with a longer replacement cycle is something that is not well received in the marketplace. So in this sector, customers being given treatments using equipment which may be becoming outdated. That could lose the business revenue or may lead to dissatisfaction with the customer. It may also be the case that as the machines get older, there are breakdowns which have downtime, which would affect, again, the ability to achieve revenue. And we just discussed how close the answers were in terms of the annual equivalent cost, and the replacement every year was only marginally more expensive than the replacement every 3 years. So it may be that those other benefits in terms of having up-to-date machines and limited downtime may outweigh that slight additional cost from the shorter replacement cycle. So it does not take into account technological changes, longer cycle, or impact from obsolescence, customer expectations, impact of downtime through breakdowns. So we've got 3 concise and relevant points there. So that should certainly be sufficient for our 2 marks. So just to recap on the calculations that we did for this question, and which will be repeated across other replacement analysis questions, we did a mini NPV calculation for each of the replacement cycles. Then we divided that net present value by the annuity factors that we calculated to give us an equivalent annual cost. It gave us a number which we could compare across different replacement cycles. And then we compare those equivalent annual costs for each of the replacement cycles, and we select the lower one as being the best option for the business, purely on a financial basis. So by going through this topic, you should have gained a good understanding of how the replacement analysis is developed from your understanding of NPV cash flows arising both in and out. We're focusing on the net cash out position in this situation, the discount factors and how they link into annuity factors. Make sure you're comfortable with your understanding on that. So that concludes the class today on replacement analysis. It's a fairly straightforward, small niche topic, but as you can see, if it comes up, you have the opportunity to gain some straightforward marks from relatively straightforward calculations. As always, please review the FM materials and make sure you're confident with the technical content. Then review the master plan questions and make sure you can repeat the work that we've done here from memory and practice those questions within the master plan one after the other. As you do so, you'll note the repetition within the exam questions. You'll become more confident until ultimately you are exam ready.